Good day, viewers. I'm Bahroze Kamdin, and I will be covering what is Equalization Levy, to which payment does it apply, whether the levy results in a double taxation for the non-resident taxpayers, what are the clarifications and reliefs sought in this budget 2023, which is going to be presented in Parliament on 1st February 2023. Equalization Levy was introduced by Chapter 8 of the Finance Act 2016. It is not a part of the Income Tax Act 1961, as it is a levy on the consideration of fees paid to non-residents. It is akin to an indirect tax, like a securities transaction tax or a service tax, etc. Equalization Levy initially in 2016 was chargeable at the rate of 6% on the payments made to overseas entities for online advertisement and digital advertising space and related services by Indian entities carrying on business or profession. By Indian entities, I mean entities that are resident in India for tax purposes, as also permanent establishment of non-resident entities in India. This levy is commonly known as the Facebook tax or the Google tax, as it taxes the advertisement income earned by these foreign platforms, websites, search engines, digital facilities, apps, etc. This levy is collected by way of a deduction of tax prior to making any payment by the Indian entities to the non-resident entities. The Finance Act 2020 brought electronic sale of goods and services within the ambit of Equalization Levy. The levy is now additionally applicable on payments received by non-resident from Indian residents, Indian IP holders, or specified non-residents for the sale of goods and supplier services online, commonly known as the Amazon tax or the Flipkart tax. Here, the non-resident e-commerce operator is required to pay 2% of the gross sale consideration as equalization levy. The Finance Act 2021 further clarified what is online sale of goods or supply of services, and said that any one leg of the activity which is online could also mean it's an online sale or online supply of services. One leg of the activity could be acceptance of the offer for sale or placing of the purchase order or acceptance of the purchase order or payment of consideration or supply of goods or services partially or wholly online. Thus, even one leg of the online transaction can trigger an equalization levy. Equalization levy does not apply to payments made towards royalties and fees for technical services, which are taxed under the Income Tax Act 1961. India was not the only country to introduce this equalization levy. Few other countries also applied digital services tax, a tax on the digital sale of goods and services. Globally, OECD and G20 inclusive framework is also working on a consensus-based reallocation of taxing rights to market jurisdictions for digital sale of goods and supply of service instead of each country taxing it unilaterally. On October 8, 2021, 138 countries which are members of the OECD and G20 inclusive framework reached an agreement on the statement of two-pillar solution to address the tax challenges arising from the digitization of the economy. Pillar 1, which is like a substitute to our equalization levy, provides taxing rights to those countries which are market jurisdictions. By market jurisdictions, we mean country where the customers that use or consume the products and services reside. Pillar 1 should apply to those multinational entities that have a global turnover exceeding 20 billion euros and 10% profitability. There's a formula-based allocation of residual profits earned by multinational groups to such market jurisdictions. The statement also provides that profits allocated to market jurisdictions will be relieved using either the exemption or the credit method by the country of residence. This should eliminate double taxation of the income which is subject to tax under Pillar 1. As per the statement, each country could continue with its unilateral tax measures till such time that the Pillar 1 comes into force. So India can continue with its equalization levy till such time that the Pillar 1 comes into force. USA and 5 other European countries, Austria, France, Italy, Spain, UK, signed a joint statement on 21st of October 2021, outlining the transitional provisions that would be applicable in this interim period from 8th October 2021 till such time that the equalization pillar 1 comes into force. It provides that any excess tax recovered by the 5 European countries under its unilateral digital tax service tax from 8th October till such time that pillar 1 comes into force will be creditable against the pillar 1 tax payable in these 5 jurisdictions. Thus, it appears that the method of computation of pillar 1 tax is deemed applicable from 8th October 21 in these 5 European countries vis-a-vis USA. India similarly signed a statement with USA on 24th November 2021, whereby the interim period starts from 1st April 2022 till such time that the pillar 1 is adopted or 31st March 2024, whichever is earlier. Thus, any excess tax that is recovered by India will be creditable as against the pillar 1 tax that becomes payable on implementation. Thus, the method of computing pillar 1 tax is deemed applicable from 1st April 2022 for India vis-a-vis USA. So going forward, once pillar 1 comes into force, hopefully there should be no double taxation for the income attributed to the market jurisdictions like India, as there should be a credit or exemption mechanism in the home country for such levy. However, what about those entities that are not covered by pillar 1? Equalization levy is not a tax on income under the Income Tax Act, and so should not be covered by the definition of taxes in the double taxation avoidance agreements. Consequently, claiming credit for the equalization levy against the corporate income tax in the home country may be difficult. Since this is a levy, can deduction be claimed in the home country for taxes paid in India like any other indirect taxes? For example, Inland Revenue Authority of Singapore has mentioned that digital taxes, which are in the nature of turnover taxes and not income tax, can be claimed as deductible expenses. The applicability of this rule, however, requires proper examination of the overseas local laws. Next, we discuss some of the key clarifications required and expectations from the budget 2023. Equalization levy does not apply to non-residents, which has a permanent establishment in India, as any amount which is attributable to the PE in India would be taxed as normal income tax at the rate of 40% plus surcharge and cess. In several cases, non-resident e-commerce operators have taken a stand that they do not have a PE in India, which is challenged by the income tax authorities, and the matters are pending in litigation. In such cases, if the taxpayers win an appeal and gets a relief that it lacks a PE in India, and so no taxes in India, then the tax authorities could attempt to levy equalization levy on the online supply and sale of goods and services to India. This creates ambiguity for the non-resident taxpayers in absence of any clarity or specific guidance thereon. Likewise, it could also lead to tax authorities losing revenue, as there may be cases they may not be able to apply equalization levy until the PE matter is finally judicially determined by the higher appellate authorities. Judicial proceedings on the subject should be referred to. There could be situations where equalization levy has been paid by the non-resident because they are claiming they did not have a PE in India, and then the tax authorities have challenged and held that it constitutes a PE in India, and income is chargeable under the Income Tax Act. The equalization levy should be refundable or creditable against corporate income tax liabilities raised. There should not be double recovery of taxes, and suitable amendments are required in law to provide for such credits. The scope of digital service tax in many European countries is quite narrow and restrictive, such that the regulated services are outside the scope of digital service tax. Similarly, OECD Pillar 1 proposal also excludes financial services sector from its scope of Pillar 1. Applicability of equalization levy to financial services sector could lead to strange outcomes, as even a simple transaction of transfer of money through digital means could bring an offline sale of goods or services within the ambit of equalization levy. Thus, financial services sector should be specifically clarified to be outside the ambit of equalization levy. There is also an ambiguity on the amount on which the 2% equalization levy is applicable. An e-commerce operator earns commission of fees, and so whether the 2% equalization levy is applicable on the fees earned by the e-commerce operator or on the gross sale consideration of goods sold by the e-commerce operator through its platform. The goods sold by the e-commerce operator may not be goods belonging to the e-commerce operator, but he could only be facilitating the sale and could be actually sold by unrelated third parties. It should not happen that the e-commerce operator is charged equalization levy and then the third party seller of goods and services are taxed either under equalization levy or under Income Tax Act as having significant economic presence. Suitable clarifications should be provided for this effect. There may be a case where a seller and service provider allows his customers to return the goods and services within a specified period and they refund the money received. Whether such return of sale consideration can be reduced from the amount on which equalization levy is applicable. As we saw, equalization levy of 2% is applicable on gross sale consideration. Would the gross sale consideration be considered after reducing this return of refunds? Exemption is available for e-commerce operator whose sales turnover or gross receipts from e-commerce supply of services or sale of goods made or provider facilitated is less than Indian rupees 20 million. In case of marketplace e-commerce operator, merely facilitating that sale, whether the entire transaction value as is collected by it would be included in computing the above threshold, or only the fees that it received for facilitating the e-commerce operation, would that be considered? Suitable clarification should be issued on this respect. These are just some of the points on which clarifications would help. With the introduction and adoption of Pillar 1 by India, there should be uniform application of the provisions and so hopefully lesser ambiguity. I hope you find this useful. Thank you.